How to finance your ADU. Building an ADU is a kind of a hot topic in Southern California right now. So in this video, I'm going to share 6 different loan options so you can finance your ADU. I'm making this video because I had a couple inquiries about financing options when building an ADU. If you haven't already watched my other video breaking down the ADU cost and timeline, go ahead, here's a link to it. So yeah, this is like a direct email from a viewer, and so this is why I'm making this video. So to just go over this, right, I'm going to share 6 different options. I'm going to give a quick summary of what that loan is. I'm going to give some pros, some cons, and what situation I think that financing might make sense or be the best option. Before I go into the 6 loan options, it'd be super helpful if you could just leave a comment letting me know if you like the ADU content and what other questions you have regarding ADUs. Without your feedback, I have no idea if you actually enjoy like these ADU videos or not. Thanks for watching. Let's dive into your financing options for ADUs. So here I'm going to share these 6 options. Number 1 is a HELOC, home equity line of credit. Number 2 is a cash out refinance. Number 3 is a HELOAN, that's a home equity loan. Number 4 is a renovation loan. Number 5 is kind of 2 actually, personal loan or private money. And last but not least, we got number 6, construction loan. So number 1, the home equity line of credit, aka known as a HELOC. That's a second mortgage, so you can already have your existing mortgage and then this will be a second mortgage on top of it. Basically just allows you to use the equity in your home as a line of credit. And so you can use this for any reason that you want, right? A lot of people might use it for maybe like high interest card debt consolidation, but we actually used a HELOC to build our ADU as well. So what I really like about the HELOC is that it's flexible. You don't just have to use it for ADU, you can use it for other things. The second is that you can draw on it. Let's say you have a $500,000 line of credit. Maybe your ADU is only $150,000. Maybe you want to consolidate some other debts, so you only draw $200,000 of the available $500,000. And so what's cool about that is you actually don't even pay interest until you actually draw. So you're only paying interest on, the $200,000 of the available $500,000. And that's after you actually draw on the money. So normally with a HELOC, you're going to have a 10-year draw period. So that means you can draw that money for up to 10 years. And you're typically going to have a 20-year payback period. Now, obviously, you could structure that loan depending on whatever is available. And so here's the risk of a HELOC, right? And any type of loan that uses your home as collateral. If you miss those payments, the bank can foreclose on your home. There's a potential of losing your home. The other thing that is not amazing about HELOCs is that the rate is variable. So usually every year the rate changes. So the rate could go up, right? Like that actually happened to us. When we got our HELOC, rates were in the 3s, and then like a year and a half later, rates went up to like 6 or 7. So our payment went up quite a bit. And so we knew this with the HELOC that it was a possibility the rates go up. We were comfortable with it. I think the best situation for a HELOC is if you just have a ton of equity in your home. You don't want to touch your first mortgage because you have a super low rate on that. And you are comfortable and understand that like, yeah, I can handle these payments if they go up. So in our specific situation, we always knew we were going to get the HELOC. And then we're probably thinking about doing a cash out refinance in the future when rates are a little bit lower. And so that leads me right into option number 2, cash out refinance, right? Most of you are probably pretty familiar with this, but I'm just going to go over what it is. A cash out refinance is a first mortgage that basically takes advantage of the equity you've built in your home, and it gives you cash in exchange for taking on that larger mortgage, right? And so this is a little bit different than the HELOC, right? Because the HELOC is a second mortgage. You could just keep your first, put the second. This cash out refi is going to replace your first completely. What are some pros of a cash out refi? Typically, you're going to have a lower interest rate than a HELOC. Your payments are fixed, right? You can choose different terms, right? You can do like a 15-year or a 30-year, but your monthly payment is going to be the same throughout the life of this loan. Also, you're going to get a large lump sum of money all right at once, right? The HELOC, you can take 50K out, 50K out, 50K out. Whereas with the cash out refi, you're going to get all 150 all at one time. Oh, I forgot to mention for HELOC as well, another pro is that your interest payments could be tax deductible depending on the situation. That's the same thing with the cash out refi. Consult your tax professional to see if that mortgage interest is deductible. So some of the cons of the cash out refi: first, you could get foreclosed on. If you stop making those payments, the bank could say, we're taking your house, right? But that's with kind of any of these that use your home as collateral. The second con is that with the cash out refinance, your repayment term probably will be longer, right? Most people choose the 30-year option. So that means the interest that you're paying over that 30 years going to be higher than if you take a 20-year HELOC. With the cash out refinance, you're going to have some closing costs. Some people, they just finance those and they roll it into their loan, but you're probably going to pay for an appraisal. You're going to pay for, loan origination fees, discount points, the standard refinance fees. Now, just a quick reminder, equity is just the value of your home minus the remaining loan balance on that home. So in both of these examples, the HELOC and the cash out refi, you're using that equity and tapping into it to get funds. And so the situation I really like the cash out refi for is if you currently already have high interest rate, right? That could be a win-win. You could potentially lower your payment, take a larger loan balance, get the cash out. So you could be getting this money not for free, right? But you could be actually lowering your monthly payment if your current interest rate is higher than what is available today. Now, if you have a low interest rate and you're considering a cash out refi versus a HELOC, you're going to need to compare the blended rate, which is the low rate plus the HELOC versus the cash out refi. Another thing to mention, right? The cash out refinance is a first position loan. The HELOC is a second position loan. Now, the third loan option that I'm going to talk about is called a home equity loan. That is a second position loan with a fixed payment. And so basically a HELOAN is a second mortgage that, once again, uses your equity, and you're basically going to have just a fixed payment instead of a variable payment. Some of the pros of the HELOAN are that it has a fixed payment. You're going to get the large lump sum. You can use the funds for whatever you want. And the interest payments are potentially tax deductible. This is very similar to the cash out refi, except for it's a second position loan instead of a first position. Some of the cons of this, though, are typically you're going to have a shorter term than a cash out refi. You're probably going to have a higher interest rate than a cash out refi, and that means you're going to have a higher monthly payment on this type of loan. So the situation where I think this maybe could make sense, right, is you already have a super low first mortgage, low interest rate, low payment. You want to keep it, and you don't want variable payments on a second loan like the HELOC. So you do a home equity loan instead. So then that way you keep your monthly payment fixed for all payments. Now that I've shared 3 of these ADU financing options, if you do have any questions, go ahead and email me here, questions about ADU financing or questions about ADU in general. Here's my email. Now let's go into financing option number 4, renovation loan. So a renovation loan is exactly what it sounds like. It's a loan to help you do renovations. Typically, this is going to be based off of the after repair value of your home. And so if you're not familiar with after repair value, that means what the home will be worth after you've done all the renovations. There are 2 very well-known renovation loans, an FHA 203K, that's a FHA loan, and then there's the Fannie Mae Home Style Loan. What's cool about these is you can actually use these both on a purchase or a refinance. So let's say you buy a home and it needs renovations, you could technically use this type of loan to acquire and fund some of the construction. Now, the pros of these types of loans is that you're typically going to get a better rate than a HELOC or a HELOAN. You're going to have these fixed payments. You're going to have pretty strict guidelines and processes to follow. And then once again, right, the mortgage interest could potentially be tax deductible. What I don't like about these loans is also the same thing, is it's kind of a two-edged sword here. Like if you have strict guidelines to qualify and a strict construction process to follow, it makes it more complex. And so like a full disclaimer here, I don't know anyone that has successfully actually used a FHA 203K or a Fannie Mae Home Style Loan to build an ADU or even purchase and do renovations, because the process is a little bit complex. Now, I'm not saying that it's not possible. I'm sure there are some FHA 203K experts or Fannie Mae Home Style experts out there. I just personally have not met anyone that has used this product. Now, I do think this is a very interesting product that could make a lot of sense for maybe a contractor or someone, maybe like a project manager, someone that is very, very familiar and comfortable with the construction process and that they're purchasing their home and they want to build an ADU as well. Okay, here's the fifth way that you can finance your ADU. So a personal loan or private money. This one's actually two different options, but I kind of lump them together. A personal loan is exactly what it sounds like, right? It's you go to a credit union or a bank and they just give you a large lump sum of money. It's, you know, usually a fixed payment, so your monthly payment will be the same. Obviously the rate, the terms, all that other stuff is going to depend on your credit score, your credit history, your relationship with that banking institution. The pros of the personal loan: no collateral, fixed rate, and it's usually approved really fast. So you could probably get approved and get that money within 24 to 48 hours. The cons, or the downside of the personal loan, is usually it's a short payback period, so your monthly payments can be high. You're probably going to have high interest rates, and you're usually not going to be able to borrow as much because there's no collateral involved. Okay, and then the next one is private money. You're probably wondering, like, what is private money? So private money is what it sounds like again. You're borrowing money from friends or family or a loan shark. No, I'm just kidding. Don't talk to a loan shark. But obviously the pros in this one is everything's negotiable, right? This is just basically your relationship with someone. If they trust you, if you have the ability to repay them, if you're comfortable doing this. Personally, I think this is the best option if it's available, right? Not everyone has this available to them, but there's no loan origination fees. You don't have to worry about signing any like collateral away. But once again, it's all negotiable. It all depends on your relationship with the private investor. And the downside of it is also everything is negotiable, right? Like this, if you don't pay someone back or things go south, like you could ruin a relationship, right? This could get really, really sticky if it's not done the right way. So with the personal loan, I think it's a great situation for someone that has amazing credit. Maybe they don't need to borrow the full amount to build their ADU, but they just want to finance some of it. It's a pretty straightforward process, but it might be a little bit more expensive. And so private money, if it's available, I think could be the best option because A, it's probably going to be the cheapest, and B, you're potentially helping your friends and family because you're helping them make money on their money. This is not financial advice. I'm just giving information and sharing ways that you could finance your ADU. And so number 6, I'm just sharing it, is a construction loan. Construction loans are a little bit more complicated than your standard loan products that I mentioned before. The construction loans will typically require completed plans, your schedule, a budget created by your licensed and insured general contractor, and usually the lender won't even fund your loan until you have building permits in hand. And then additionally, with the construction loan, they're only going to give you funds in draws. So what that means is the lender's only going to release payments to the contractor based on their progress, right? And so that's going to be, so this could kind of like cause some delays in the process. Also, in my experience with these construction loans, sometimes their inspector doesn't agree with the progress, and that can cause delays in how much gets paid to the contractors. Overall, right, the pros of using a construction loan is that it's usually an interest-only loan during construction. It's also going to be like a custom tailored loan to your specific scenario. Also, if a lender's willing to lend on a construction loan, that means that your process has been dialed in and everything will be done very orderly. The cons of it is that with the additional amount of paperwork, additional amount of reviews, and then like always having to deal with this draw schedule, it can add a lot of delays to your project. On top of that, some of these construction loans will charge you a additional fee every time you draw. Big thing with these construction loans, if you're really familiar with it, cool. I don't personally know anyone that has used a construction loan to build an ADU. Personally, I think the other options that I provided are better, more simple, and that's what most people will use. So just to recap, the 6 types of financing that you can use to build your ADU: 1, home equity line of credit, the HELOC; 2, the cash out refi; 3, the home equity loan, a HELOAN; 4, a renovation loan; 5, personal money or private money; and 6, construction loan. As always, I appreciate you watching and supporting the channel. And so if you found any of this helpful, go ahead and smash the subscribe button.